I'd like to take this opportunity to introduce Megan to you. Megan has been with our group since sometime last fall. But if you remember, Kim was with the same bank, and Kim was with us for a couple of years. And then she got Megan to come in and take her place. So between the two of them, they've represented their bank quite well for at least probably 3 years. Okay, so Megan, I'll turn it over to you.
Thank you. Good morning, everyone. I'm mbuder with First National Bank. I'm a personal banker there. We can provide you with all of your banking needs, from checking accounts to savings accounts to loans. Right now, I wanted to zero in on a conversation I have with many of my clients, and that is debt. They're in debt and they don't know what to do to help them get out of that position. So a lot of people come to me, they have their house, they have their car, kids, they want to take vacations. When those go outside of their daily needs, they end up with a lot of credit card debt. That is the hardest debt to deal with because the interest rates are so high. So there are options for individuals with high credit card debt that are looking to pay that debt down faster, for easier payments, for the ability to get that debt taken care of so that in the future they can focus on saving and gaining that investment income that they're looking for, gaining their comfort in their lifestyle. So this is a scenario I had with one of my customers. Kind of rounded out the numbers a little bit for you, but overall they had $15,000 worth of credit card debt and interest rates in the high teens. Averaging at about 14%. So their monthly payments, they were paying just the minimum. They couldn't afford more than just that minimum. They needed help getting that taken care of. So if you're looking at that, it takes you 109 months, so years and years and years, to pay off that debt at that interest rate. It's going to take you a long time. You're only making the minimum payments, so you're mostly paying interest each month. You're not contributing to principal. So what can we do? What can we get you into, or what can we help you with that gets this debt down faster and makes you more comfortable with your lifestyle? We can look originally at a personal unsecured loan. The good thing about personal unsecured loans is there's no collateral required. You don't have to own a home, you don't have to have a car, you don't have to have assets that we need to use to offset that. We can look at a lower interest rate than what you're looking at with credit cards. You're looking at one monthly payment rather than having 5 or 6 credit card payments that you have to keep track of, making sure you're on time, making sure that's not affecting your month-to-month bills, and we're paying more money to principal. So rather than just paying the minimum payment of $25 and just covering interest each month, we're actually contributing to principal each month. So you're paying down that loan over the life, rather than looking at the credit card and just paying the minimum balance, and then you see in the corner there, it'll take you 7 years to pay this off if you can continue making this payment this way. And you can also pay your debt off faster. So looking at that scenario, we can compare the two. We have our credit cards that we've already discussed on the left-hand side here, and then we have our personal loan on the right. You can see their rate is significantly lower at 7.99 for that unsecured loan. Term to be debt-free is only 60 months, so only 5 years. Cuts that term in almost half. Monthly payment there is only $4 more a month. And like I said, you're paying towards principal. You're paying towards that debt rather than just the interest. And finally, the total interest to life of the loan. You can pay $10,000 in interest to pay off your credit cards, or you can pay $3,000 in interest to pay off that loan. Looking at that comparison, is it really even a question? You're saving almost $7,000 in interest. So, a lot of people say, well, I do have a house. What can I do can that help me? Yes, it can. It can get your interest rate lower, as low as 3.99, for example. So a home equity loan or a home equity line of credit, we'd use your home as collateral to help you pay down that loan. We can also use a car as an auto-secured loan, or we can look at other secured loans. Let's say you have investments, or you have savings out there, but you don't want to take all of that savings that you're earning money on to pay off your debt. You want to use it to keep earning. You can use another secured loan as well. So there are a lot of options for you that we can help you with. Well, what if you don't qualify? It happens. Some people have poor credit. they're not able to qualify for a new loan because they've been late on their credit card payments and they have that debt out there that's affecting their credit. What if your debt to income ratio doesn't line up? We do have to make sure that you can pay back the loan with how much you make each month. With all of the debt that's out there, that may not come into play. Another thing that we run into a lot is with self-employed individuals, we do have to be able to verify tax returns. But if you're not reporting your full income on your tax returns because you're taking the personal deductions because you're self-employed, it offsets that ratio for us. So that's something we need to look at as well. Also, recent bankruptcies and other financial losses can come into play and affect the ability to lend. So now what? You come in, we've talked about this, these options look great, but you don't qualify. That's not where I stop. Some banks might stop and say, well, you don't qualify, have a nice day. I want to look at options that can really do something for you. So one thing I work with a lot is called the debt snowball. This is more of a counseling, more of a strategy technique that I use rather than a new lending product for you. The debt snowball, what you do is you take your regular payment amount here and you say, all right, I'm paying $300 a month. I can scrounge up another $175 a month to help you pay this debt down faster. So you'll take that debt and you'll pay your regular payment plus that $175. So your new payment on that first credit card is $200. That pays that one off. Done. Then you take that $200 and you apply it to your next credit card down. So you have your $25 that you were paying before, and rather than paying the additional $175 or going back to just paying $25, you pay $225 total. Pay that card off. Then you run it down to the next one. So you're continuing to take that new payment and applying it down every time. So by the time you're done with that, rather than paying $100 on that final credit card, you're paying $475 a month. That's really going to increase your ability to pay that debt off faster. It's going to go really fast once you get down to your second or third card, and even faster when you get to that last card. So looking at that comparison, we have our term to debt free is only 41 months, and your payment amount is $175 a month more. So yes, you have to pay more. Yes, you have to come up with those additional funds each month, but you pay off that debt 5.5 years faster. So once again, you're saving on interest, you're saving on time, you're getting yourself into a better place faster. So like I said, we don't just finish with the loan. We look at every option. If the loan doesn't work for you, we'll find something more. And we have rescued people who have been buried under an avalanche of debt. We can get you out of that situation if that's what you need. And that's all today. Thank you.
So we've got some time for any questions that you may have for Megan.
Yes.
Auto secured loan. So you've got an automobile that's free and fair.
Yes.
What kind of interest rate generally?
It depends on the year of the car and your credit score, but we're generally looking anywhere from 2.99 to 7.99 depending on that year of the car. But yes, so if you own your vehicle free and clear, or if you have a loan out there that you've paid down and your vehicle is worth more than that, we can utilize that to collateralize it and get you a lower interest rate.
Who are the people who qualify for an unsecured loan?
The unsecured loans, anybody can qualify for an unsecured loan as long as you can show that you can pay it back and that you have a credit score that supports it. So both of those things are taken into account for an unsecured loan. The one limitation with unsecured loans is the value. We can only go up to $20,000 with an unsecured loan. Outside of that, we're going to need something to collateralize it with. We're going to want to look at a vehicle, or we're going to look at a home. So if someone comes in with $50,000 worth of debt they're looking to consolidate, we're going to be looking probably at a home to help collateralize that. So we want to have that support as well. But any individual can qualify for that if they have the ability to repay. Yes?
How often should a person look at their credit rating, their credit scores?
So-
And is there a point where it's detrimental to your credit?
So if you do what's called a hard pull on your credit, it can pull what's called a couple points off of your credit, can take it down. But if you do what's called a soft pull, you can look at your credit score whenever you want. A lot of people, or a lot of places nowadays, like if you have a loan with someone or if you have a credit card, it'll show you your FICO score on your monthly statement. That's a soft pull. It doesn't affect your credit score. Another way that you can do it is called annualcreditreport.com. It doesn't show you your specific score, but it can show you your history. So it can show you when you've made on-time payments, when you've made late payments, any collections that are out there that you didn't know about. What if you had a medical bill 20 years ago and it just disappeared and you thought it was taken care of? It might still be on your credit and hurting you. So seeing that history can help you recover that credit score if you need to build that.
So Credit Karma?
Credit Karma is, so the difference between annualcreditreport.com and Credit Karma is that Credit Karma is not a federally guided website. So the annualcreditreport.com is supported by the federal government, so you know that you're getting the correct information, whereas creditkarma.com is a privately held organization, so they may calculate things and look at things a little bit differently than we as a bank would.
You know, when you refinance your home because the interest rates are lower, is there a rule of thumb for when you should do that?
So refinancing your home is dependent on both interest rates and what you're looking to do. You can look at, if you're wanting to get your payment amount lower, you can refinance at that time, or you can look at maybe getting a shorter term mortgage, so a 15-year rather than a 30. So that would be a good time to refinance. But like you said, interest rates are low right now, so if you're looking to refinance and that's something that you want to do, I would recommend doing it sooner rather than later, because we've already seen one increase in the federal rate this year. We're expecting another one, and we're hoping, everybody's expecting rates to continue to increase.
So I've got three things. One on the snowball method, which I actually learned from Trevor, who used to be in this group. And I took his workshop, and it didn't make sense to me in the sense that you would think you focus on the highest interest rate first. That's actually not what you do in the snowball method. You focus on the lowest balance first, so you can keep snowballing and making higher payments. And I thought he was crazy until I'm a spreadsheet guy, until I put it to a spreadsheet. And it does actually work that way, better than just focusing on the highest interest rate. Interest rates weren't even on there. You're focusing on the lowest balance first. So it really, I love that method, and it works really well. The second thing is, everyone in here, if you can afford it, not if you can afford it, but if you have the equity in your home, everybody should have a HELOC loan.
I agree.
The bank will always give you a loan when you don't need it, and whenever you do need it, they might not give it to you. So having it out there and not using it, but having it as an emergency for liquidity, it's great. You can deduct it on your taxes, assuming you don't fall into the alternative minimum tax. It's a great tool to consolidate debt. And I would highly recommend everybody talk to Megan about a home equity. It doesn't matter if you have debt, but do that. And then the third thing is, if none of this works, Rob and other businesses, she's a loan shark. And she'd be willing, I'm sure, at a slightly less interest rate from your credit cards to work something out. But if you don't make your payments, be careful.
But yes.
She'll force Whole Fruits and vegetables on you. Just all goes downhill quickly. Exactly.
So Dan makes a great point with the home equity line of credit when he said, when you don't need it, we'll give it to you.
Yeah.
So if you have the equity in your home, we can get you a home equity line of credit, and we can do it for free. We can do it for no cost to you, zero closing costs. So you're not paying any interest if you don't use that line of credit. It just sits there, $50 annual fee to keep it maintained for you. But other than that, you just have it out there for 10 years. What if one of you or your partner loses your job and you're starting to kind of flounder? You can borrow from that. What if you have a medical emergency where you owe $30,000? You can borrow from that. So there's a lot of opportunity there as well. So
Do you work with young kids that are just starting out of college?
I do. I do a lot of credit building techniques with people who are just out of college or just turned 18, because that's when you can officially, get a credit card on your own as 18. You can be an authorized user and build that history on your parents' credit card, for example, but 18 is the magic number. A lot of kids don't know that you have to have good credit to rent an apartment nowadays. You can't just walk in and say, I want this apartment. You have to be able to prove that you'll be a good borrower. They don't know that. So, an 18-year-old says, oh, I'm going to move out of my house when I turn 18, or when I, turn 20. You have to have the credit to do so. Or your parents are co-signing on that apartment with you and you're still stuck with your parents. So that's something that you, so that's something that we talk about a lot, is how to build credit, how to get you into a place where that credit looks good for kids. and also to look at, individuals who their credit has dropped for some reason, how we can get that back up into a profile where apartments will into you can get a car loan, you can buy a house, all of those things credit comes into play with, and a lot of people don't realize that.
So we could bring our children to you, you could,
Yeah.
the parents would be there also?
Yep, usually it comes in when a parent says, my son needs a debit card. How old is your son? He just turned 18 and we want to get him set up with his first bank account. Great opportunity to have that conversation. So that's usually how it comes about, is they bring their kids in for their first account that's not a minor savings account.
Well, if you got any more questions or anything, you can get with Megan afterwards, but thank you, Megan.
Thank you.